everyone. Thank you for being here. It's a nice day outside, so thank you for spending your time a little bit inside. Andrew and I thought it would be raining, so that you'll be forced to be inside, but it's not yet. So anyway, I'm Rod Rejesus. I'm a professor in Ag and Resource Economics at NC State. So I work a lot on my research on extension, both in crop insurance, risk management, and sort of like agricultural technologies and assessing economic impacts of these technologies like precision ag, GM crops, cover crops, those kinds of things, and looking at the economics of it. But today I'm going to talk a little bit about crop insurance. So, Andrew, just introduce yourself and then I'll start afterwards.
Sure. My name's Andrew Branan. I'm an extension assistant professor. It means I teach agriculture law and environmental law on campus, and then most of my time I'm working on legal issues for members of the public, or just answering questions and producing materials to address a broad range of topics, from farm succession planning and estate planning, business organizations. Today we're talking about risk management, insurance, but also conservation issues, any number of issues related to land, and so that's my job. That's what I do.
All right, thank you. So I'll try and share my screen here and see if it works. Hopefully it does. All right. Do you see it okay? Let me try to do the, okay, now it's sort of the whole presentation. Okay, so as I've said, I'm going to talk a little bit about crop insurance today. And based on guidance from Sarah, we sort of thought that it would be good to start essentially from the start and provide an overview, a basic overview of U.S. crop insurance. And I saw I guess in the poll, not everybody has some experience with crop insurance. So I think it's a good starting point. Describe the different products that are out there and just give a flavor of how it works. And then focus a little bit on specialty crops. I noticed again in the poll, nobody put sort of row crops or something like that. And that's important because crop insurance historically has been geared towards row crops. Okay. So again, sort of Sarah mentioned to me that, well, most of our folks in Davidson probably is on the specialty crop side. So meaning fruits, vegetables, and other non-row crops. And so given this, I'll try to sort of talk a little bit about what they call WFRP and NAP, which are the ones that are sort of targeted for specialty crops, fruits, vegetables, those kinds of things. And then there are several people that put livestock as their main products that they raise. And so I'll put discuss a little bit about the livestock crop insurance options. But the sad thing about that, though, is there's not much in livestock, and so that's I'm going to make that clear off the bat. But I'll talk about it and see. I mean, it's not very popular, but there's some insurance for livestock out there that you could consider. So that's the plan for my about 30-minute presentation today. Okay, so I guess most everybody know that crop insurance is now one of the most important tools for managing risk in U.S. agriculture, especially for row crops, right? Approximately 85% of total crop acreage is now insured. For the large row crops, corn, soybeans in North Carolina, for example, 89% of total crop acres are already insured with some sort of insurance product. Okay. Now, the flip side to this, though, is that, yeah, it's popular for the row crops. There's what the crop insurance industry called underserved commodities, and those are the specialty crops, the fruits, the vegetables, even sweet potatoes, for example. It's a big crop here in North Carolina, but it doesn't have its own sort of product sweet potato specific crop insurance product in North Carolina. So there are crops and commodities that are relatively underserved. Okay. But crop insurance in general protects against losses due to natural disasters and price decline. So there are products that covers both, and there's a product that just covers sort of yield or natural disaster effects on production, and the more popular products cover both. And crop insurance is not new. It's been available since the 30s, but only in the 80s has it sort of started expanding. And with the increases in subsidies in the 90s and 2000s, it has taken off, especially in the Midwest and for major row crops. So the basic idea for crop insurance in the US is that the premiums and the contract terms is set by FCIC, the Federal Crop Insurance Corporation, and all of the federal crop insurance program is administered by RMA, the Risk Management Agency of USDA. But insurance policies are sold through private insurance company. So this program is what they call a publicly supported, privately delivered program. So essentially, you still call a private insurance agent to get a policy if you want one, though the terms of the contracts offered by these agents are administered and guided by RMA and FCIC rules. Okay. And premiums and delivery costs are federally subsidized. So that's the good thing from a farmer perspective, wanting to get coverage for crop insurance. So it's like, instead of paying $100, for example, if it's in State Farm, if it's a crop insurance, you could just pay $50. Okay, so it's sort of subsidized in that sense. General pros and cons, of course, the pro is it's a safety net, right? So I mean, it allows you to have, if you get wiped out by a hurricane, you're not totally wiped out in terms of, zero income, because you could get some insurance payment. So there's a little bit of a safety net that gives a little bit of peace of mind in times of disasters, right? And another pro is, of course, a lot of banks nowadays, if you're wanting operating loans, they ask for whether you have crop insurance. So if you do, that helps in terms of accessing credit for your operations. And of course, the con is that it's not costless, right? Compare that to the commodity programs like ARC and PLC in the Farm Bill. All those are free. You just need to sign up in your FSA office. If a disaster comes and it triggers, you get a payment, you didn't pay anything. But in this case, crop insurance, you have to pay some amount, although it's subsidized, as I've said. So that's sort of the con. So there's a trade-off there about the amount of coverage you want, plus sort of the amount you're willing to pay. Okay? The other cons that has arisen over the years is just in terms of complexity. So it was fairly simple program in the 80s, but over time, a lot of different products came in, and it becomes a tangled mess of alphabet soup, right? So there's different sort of acronyms out there for the different programs, and it becomes a little bit hairy. So that's you need to sit down a little bit with your agents to sort of walk through the different products out there. So hopefully my presentation will help a little bit. Okay, so what are the different crop insurance? So just a very general overview of what's out there. So there are different types of crop insurance products available. So the first sort of category is sort of farm level versus county level products. So the farm level products essentially triggers based on your own farm's performance. If you have a loss in your own operation and it's below some guaranteed level, you get a payment. Okay. Now, there's also county level products, which is based on performance at the county. So in this type of product, what's important is the performance of the county. So it could happen that you got hailed out, right? In your own farm, you're near, in a part of the county. But if all the county, the rest of the county, the weather is fine, it's possible that if you bought the county level product, you got a loss, but you don't get a payment because of the county level trigger. Of course, this is a little bit cheaper than the farm level products, okay? But there's this, what they call this basis risk, is what they call that sort of risk of not getting paid, even if you have a loss, okay? Then the other major sort of categorization is this yield versus revenue-based products. So yield-based products is sort of the traditional crop insurance available in the 80s, which essentially based on your yields. It's or based on yield shortfalls, essentially. So it's on the production side of things. But in the 90s, revenue-based products came about. Revenue-based products came about, which covers both the production yields and price declines, essentially. And over the years, revenue-based products is now the more popular or the most popular product out there because of this feature of being able to insure against both production risk and price risk. Okay. So this is sort of the general sort of figure when you think about it. So if you're the insured up on top here, right, you could either pick a county level product or a farm level product. So if you pick a county level product, it's called ARPI, Area Risk Protection Insurance. And you could buy either a yield-based trigger product or a revenue-based trigger product. But again, these are based on county level performance. It's not very popular, okay? So the right-hand side of this figure is really where the action is. The most popular products is essentially these three: the yield protection, the revenue protection, and the revenue protection with harvest price exclusion, okay? RP and RPHP is essentially the same. It's just the treatment of the price that's different. And we can talk about this a little bit if you're interested in what the difference is. But essentially, the revenue products insures revenue. Yield protection just insures the production risk, okay? Now, as I've said, these products are geared mostly towards row crops. So individual row crops like corn, soybeans, wheat, cotton, those kinds of things have, in general, yield and YP and RP. But as I've said, over time, the government realized, well, there's other commodities out there: vegetables, fruits, other specialty crops. And so this little box over here where I list down CAT and then sort of WFRP, the whole farm product, are the ones they sort of develop to serve some of these non-traditional commodities, they call it, okay? So just a quick overview of how the YP and RP work. So YP, as I've said, is a individual yield-based policy. So you have some historical yield. You pick a guarantee level from 50% to 85% in 5% increments. And if your yield for a particular yield falls below that guarantee, you'll get a payment, right? So say, for example, you have 100 bushel per acre average yield. You pick an 85% coverage level, so that's 85 bushels per acre guarantee. If you had a drought in a year, your yields was 0, you get that 85 bushels per acre value of your average yield, essentially. And the price will be based on some base price that RMA sets up for that particular year that's based on futures prices. Okay. So this is the traditional crop insurance. If you go back to the 1980s, this is the one that's available in the 1980s. The problem with this thing is that it's only for row crops mostly, and only selected fruits and vegetables in North Carolina has this type of individual based policy. So apples, blueberries, cabbage, beans, cucumbers, grapes. And so there's a lot, sweet potatoes, they don't have their own YP policy. Strawberries don't have their YP policy. So those kinds of things is not available here in North Carolina. If you wanted to get, say, a strawberry YP insurance, there's nothing. There's nothing like that. Okay. The other type of product, and this is the most popular product now, is the revenue protection insurance, okay, or RPHPE. So instead of yields, it protects against shortfalls in revenue. And the revenue, though, is not based on sort of the prices that you get. It's based on futures prices. So it protects against both production and price risk, but the price they use to calculate revenue is based on futures prices. Okay, so that has some implications as well. So if you have corn, for example, they use futures prices at the start of the season to set your revenue guarantee and multiply that with your historical corn yield, for example. Okay. And it's only available mainly for row crops. So barley, canola, corn, cotton, sorghum, soybeans, tobacco, wheat. So no RP insurance for vegetables or fruit commodities. And that could be a problem, right? And so in light of this sort of issue, as I've said, RMA developed what they call the WFRP, Whole Farm Revenue Protection is what it's called, whole WFRP. And so compared to YP and RP rather, WFRP is a whole farm, quote unquote, whole farm product that insures all crops and livestock at once under one policy rather than insuring commodity by commodity. So for YP and RP, for example, if you plant both corn and soybean, right, for example, in your farm, you could insure those two crops using two separate YP and RP policies. For WFRP, you insure them all together, okay? So these are designed primarily for diversified operations and those growing, quote unquote, underserved commodities like fruits, vegetables, those kinds of things, where there's no available individual policies. Okay. Now, even though this is a whole farm product, right, for different kinds of crops, but say you just grow strawberries and you want some coverage for strawberries, you could still get WFRP, right? It's just that your subsidy is a little bit lower, okay? Because it's designed for diversified operations, okay? The other difference is that the coverage is based on your tax records. So you have to be willing to share your tax records to your insurance agents so that they could set your insurance coverage. And in general, this type of policy also requires a lot of paperwork relative to the YP and RP because of this kind of thing. So if you don't have good records, that may be a problem. But if you do, and you're willing to share your tax records, this is an option for you, especially if there's no individual crop insurance product for the commodity that you're growing, okay? Good thing with WFRP is RMA really want to push this. And so subsidies could go up to 80% when you have at least two crops that you want to insure altogether, right? One downside to this, if you're a really, really big sort of diversified operation, WFRP has a coverage limit of around $8.5 million in revenue. So if you're a really, really big operation with revenues over 8.5 million, that may be a problem. Okay. So WFRP, I think, if you're growing any of these specialty crops, fruits, vegetables that are traditionally underserved from an RMA perspective, WFRP is attractive. And it's also attractive for diversified farms, as I've said, especially those with specialty crops, farms with livestock and grain systems that are integrated. I mean, because you could insure them both at the same time. Single commodity farms not insurable by other policies like strawberries or sweet potatoes. Organic producers where you have, your price, the prices you receive is relatively higher than sort of the futures prices, for example. This is a good policy as well, because as I've said, the traditional policies are based on futures prices and some adjustment. Okay. And farmers that sell to direct markets, local markets, would have sort of like high markups on their prices also could benefit from WFRP. Okay. So this is one option for especially for specialty crop growers. Other options that one could consider is what they call NAP, okay? Non-insured crop disaster assistance programs. It's similar to YP in the sense that it's sort of a yield-based product, but you buy it through FSA, okay? So instead of RMA, you could buy it through FSA. So if you have a crop that's really not, there's no offering under individual RMA policies, you could go to FSA, get a NAP coverage that's works similar to YP. Now, before the 2014, I think, yeah, 2014 Farm Bill, NAP is just what they call CAT coverage. It's just 50% is the maximum coverage you could get. So essentially, you have to be you have to have a loss greater than 50% to get a payment out of NAP. Okay, but the good side of it is it's free. It's just some what do you call this? Some administrative fee that you pay. Okay, but with the 2014 Farm Bill, they improved NAP a little bit that you could go up to, I think, 65% coverage, though you have to pay. So there's premiums to pay if you want to go to increase your coverage for NAP. Okay, so that's one option. So especially for, again, crops like strawberries and sweet potatoes that don't have coverage through individual policies, this is an option. Okay. Now RMA also offers apiculture, nursery crop insurance, and so forth. So if there's anybody out there that's in these areas, there are some sort of niche insurance products as well. Livestock, as I've said, there's not much, and it's not popular. It's the bottom line for livestock insurance. Okay, there's two policies: what they call LGM, livestock gross margin, and livestock risk protection. Okay, LGM protects against sort of gross margin decline. So they calculate the market value of livestock less feed cost, and your coverage will be based on that. And if there's sort of like shortfalls to that, you get a payment. So that's the idea here. LRP is just a price product, so it protects you against declining prices. So that's the difference between the two. Also, LGM is only available for dairy cattle and swine, and LRP is available for fed cattle, feeder cattle, and swine. Okay, so there's some limitations. So there's no poultry here actually too. So that's one issue with livestock insurance. As I've said, it's not very popular. Only LRP for cattle, LGM for dairy has been bought in North Carolina. And so, the feedback is it's not working very well. So again, but if you're interested, of course, you could always sort of call your agent, walk you through the policy and see if it'll work for your operation. Okay. The other livestock related product is this what they call PRF, pasture rangeland forage insurance. So essentially, this is what they call an index product because it doesn't insure any of your actual pasture or rangeland. It insures based on rainfall. So the idea is that pasture is highly correlated with rainfall. So if you get rainfall shortages, it's assumed that you'll have some pasture losses. So the idea here is that if rainfall falls below some average amount, you get a payment, and it has some time element to it too. So you pick the times where the rainfalls shortages will be calculated for you. Okay, so this is another option for especially if you use pasture to feed sort of your cattle, right? So that's sort of another option for livestock growers. Okay, so as I've said, there's not much for the livestock folks, unfortunately. So if you're interested, you're new, where do you start? Contact a crop insurance agent. Okay, so there's a list in the RMA website of the different crop insurance agents if you want a place to start. But of course, you could just ask in your own neighborhood and some of your neighbors who have crop insurance to see what their experiences are. The thing with this, as I've said, it's publicly supported, privately delivered. All of them will sell exactly the same policies for exactly the same price because of the publicly supported aspect of it. You are essentially buying service. You want to find someone you're comfortable working with and is knowledgeable of the rules. This is important because there's lots of rules, as you could imagine, and you can forfeit coverage if you break some of these. But on the flip side, you could take advantage of some of these rules, okay? And the good agents will allow you to do that and they'll know what to do. The not so good ones don't. So, as I say here, choose well your crop insurance agent, okay? My take home message essentially is, just if you're interested, you haven't had this before, familiarize yourself with the different products and work with an agent that you trust. If you've had some experience with it already and you want to explore other things, again, the first point of contact is always the crop insurance agent, okay? And they could walk you through the different sort of scenarios you want to sort of look at, okay? The goal from my perspective, I guess, for any operation is you want to find adequate coverage that's you're comfortable paying with, essentially, or paying for, right? So that it could provide you good risk management safety net at the price you're willing to pay. So that's sort of the biggest take home here. Okay. Also, from my perspective, consider at least the minimum coverage. Okay, it's typically free either with the NAP or any of these other products, as long as it's offered, except for that whole farm. So there's no what they call catastrophic or CAT coverage for WFRP. Okay, but for all the others there are. Okay, so the catastrophic coverage, as I've said, is 50%. So if you get a 50% or more loss, which is really a catastrophic loss, at least you could get that 50% back. Okay. And typically, if it's a YP or RP product, it's free. It's just at some administrative fee to pay. So it's very sort of it's not expensive at all. Okay. So I think that's all I have. if you have any questions, as Sarah said, feel free to ask them now or put it in the chat. We could talk a little bit later. If you want to email, you can email me too or call. I put here the RMA website and our website as well in the ARE NC State extension website, where we have different sort of like informational materials on crop insurance and other things. So.
Rod, you did have a question in the chat. It was, in diversified operations, will the records that you keep for the Food Safety Modernization Act for receipts be able to use for WFRP insurance, or what other financial records will be needed?
Well, so the most important part is really the taxes, right? And then so if your tax records are good, that's okay. Now, the things you use for the receipts for FSMA is gonna be used in sort of calculating the revenues as well and the prices for each. So it helps, but if there's other receipts that are out there, right, that the actual point of sale receipt rather than just WFRP, rather than food safety FSMA receipts, that will help. So as I've said, sort of, I guess the better records you have, the better off you are, I guess. Let's just put it that way. Yeah, so I guess it's for Minda, yes, it's likely gonna be useful, but if there's other records to support it, that will be even better. I guess that's my bottom line answer.
Okay, if there are other questions, feel free to type those in the chat and Rod will be monitoring that, but we're going to go ahead and move on to Andrew's presentation. Rod's also sharing that presentation with me, so you will get a copy of that, but I put those two websites that were on his last slide into the chat window as well, so you would have those resources. Okay, Andrew.
Sure. Thanks, Sarah. So I'll go ahead and share my screen, and I'll show y'all where this presentation is. I'll start by showing y'all the web portal that I'm keeping on just various legal matters and how you find resources on it. And so I prepared this presentation and I put it under agribusiness law. And I'm going to go to that. Find it here under the direct customer liability, and boom. So I don't have the ability to make the full screen thing, if that's okay with y'all. I just wanted to show y'all where this was on the website, so y'all could go back and refer to it. So I'm going to talk about insurance that the government does not cover and is not mandated necessarily by federal, state, or local government, except in certain circumstances. But I'm generally going to be talking about liability insurance and property protection insurance, and it's a challenging topic in the sense that that at the end of the day, the contract covers what the contract covers. Liability and property protection insurance is purely a private matter. It's a private choice. It's dictated by your own risk tolerance. I'll show where it can be dictated by other. Well, it's also dictated by, in some respects, by vendor requirements. If you're going to sell to a certain place or at a certain place, it is likely that there are going to be insurance requirements that you have to carry in terms of liability for injuries that happen. And so, but again, it's a private matter. It's a pure matter of private contract between you and the insurer. And as I'll demonstrate briefly, the contract covers what the contract covers. And so the corollary to that is always make sure that when you are purchasing liability insurance, that your insurance agent knows what you're purchasing it for, knows your business, because that's how the insurance company is calculating what the premium on that insurance policy is going to be, what their level of risk is. And your most basic policy is just going to be what we call just a farm liability policy. If there's an injury that happens to occur on the farm, then that's something that policy covers. But as you start moving into more commercial enterprise and value-added food production, bringing people to the farm for agritourism, things like that, those are the types of things that you have to make sure that your insurance company knows about, because the basic policy that you have, those may be exceptions. And I'll demonstrate the basic policy and show that really just the business of farming is can be an exception in that policy that's not covered. I do a little song and dance quick about just the concepts of liability and regulation, because I always get a lot of folks will frame a question this way. You know, am I liable if I don't do this on the farm? Am I liable if I don't do that? Well, first and foremost, the concept of liability is something that has to be proven. There aren't really any statutes. It's not, the government does not by statute, or we the people, the voter, does not by statute say that you are, you're liable for someone else's injury or someone else's property loss just because you did an act. There are rare circumstances where common law has said that certain types of activities like blasting, like stuff that's ultra hazardous, if someone's injured, then the company that does it automatically has to pay for those injuries. But generally, whether or not you're responsible for someone else's injury or their property loss is going to be at the end of it up to a jury, based on the concept of negligence. And negligence is something that an injured person has to prove. And the basics of negligence are that you had to act in an unreasonable manner. So just because someone's injured on your farm or injured because something you do doesn't necessarily mean you're liable. Regulation, on the other hand, is not a matter of holding you accountable for someone's injury. It's purely prospective. It's not remedial. It essentially, it's again, we the people, authorizing our government through what we call its police power to protect the general health and welfare. And that's why we have regulations on food safety, on highway travel, things like that. And so the government's power in that sense is not holding you accountable for someone else's injury, but if you're violating the regulation, making you stop and you're losing the money on your investment in whatever your business activity is. I'll compress for time, so I'll move through this slide. But again, for liability purposes, and I'm now talking about this in advance of what insurance is, why you buy insurance to help deal with these situations, is that when someone's hurt, they have what we call the burden of proof. They have to prove that in like circumstance, or you did not act as would a reasonable person in like circumstances. And they have to prove 4 elements: that you had a duty to make them safe, that you breached that duty, that your breach was the actual cause of their injury, that there weren't multiple causes, but what you did was what injured that person. And they have to prove their damages. They have to prove their hospital bills, their loss of spousal enjoyment, of loss of income from job, things like that. And again, it's not a low bar if an accident actually does go before a court, and the question of your liability is what the jury is deciding. Now, as I mentioned, violating regulation. There, the government is just telling you, they use their what we call the injunctive power to make you stop. They have the force of law to make you stop operating until you correct the problem. That sometimes there might be a fine or something. But where the two are related is that if you are found to be violating a regulation and an injury has occurred, what happens is, under our common law system, a concept known negligence per se pops in. And if the injured plaintiff can demonstrate that you had, produced more eggs on your farm than were allowed under the, I think it's the 20,000 egg exemption. If you exceeded that and it's shown, then, and they got sick because of that, or, because from eggs from your farm, suddenly they don't have to prove these elements. Now you are having to show that you had a great crystal clean operation and that there's no way you were negligent. So it puts the burden, it shifts the burden of proof to the defendant, to the farm, to have to prove that that they did not cause that injury. How we deal with liability, of course, we're going to talk about insurance today. Operating in a safe manner, first and foremost, and that I know. So I'm in to put up the Food Safety Modernization Act. That's an example of government regulation that's forcing certain farms to operate in a safe manner to avoid injury. We'll talk about injury, and I'll throw insurance, and I'll throw a little bit about a business entity protection at the very end. So just as a regulation example, and this will feed into the insurance discussion, but there's our Department of Public Safety, Highway Patrol, has done a great job working with Extension across the state, talking about regulations involving farming activities out on the highway. And I put this one up because, as we all know, you can't get a car registered without showing that you are carrying motor vehicle liability insurance. So that's it's an example of where a regulation, government's power to regulate, is essentially forcing you to have insurance, because we know that in the event of accidents, that money has to come from somewhere, and the person driving may not have that money. And this is sort of the nature of regulation. It's been informed by liability law, what you saw I called tort law, over the centuries. That we know that certain activities produce certain injuries. And so regulations are formed over time to, again, be preventative and stop those types of injuries. But this is an example of one where it's going to dictate your an insurance requirement on you. And it's a fascinating topic because there's a lot of exemptions related to farming. But this is an example in the negligence per se that I brought up, that you need to make sure that you're not doing something that's violating, just by way of example, these 2051 exemptions. That if you're operating farm machinery out on the highway, and the easiest one here is for hire, that you have exemptions from having to have registration on trailers and tractors and things like that for your own farming purposes. But if you're doing the work for others, custom farming, things like that, or you're hauling someone else's hay and you need to have a vehicle registered, then you're falling outside the regulation. And then if an accident happens out on the highway, you could, negligence per se could come into play, and your chances of being found liable are going to increase. And so, but that leads to my point that, again, insurance is largely dictated. I said first and foremost, it's dictated by your risk tolerance. What do you have to lose? Because in a liability situation, what you have to lose, if you're not properly structured in your business and you're not carrying insurance, then you stand to lose it all. Your land, your savings. There's certain assets that by law are not recoverable, like insurance policies, things like that. But the reason we carry insurance is to protect our personal property from having to pay the claim of someone. But there I gave the example of when it's required by regulation, but certain types of insurance are also required when you're taking out a loan, whether you're buying a house or even in loans from Farm Credit for purchase of a farm. You have to be carrying an insurance policy on the structures. I don't know about whether or not you're required to carry general liability insurance for the farm, just for injuries that happen on your land as part of the loan. I looked through several deeds of trust that I had, and I didn't find it, but it's not outside the realm of possibility. But at the very least, you can't get the loan until, or you have to produce, at least at a certain time after closing, the certification that you've got, that you have insurance on those structures. And if you don't pay the premiums, generally as any of you know who've taken out a farm loan, part of your payment to Farm Credit or to, I guess, Farm Service Agency or whoever the lender is going to carry the insurance premium in that payment. So your monthly or annual payment's going to provide money to the company to go ahead and make sure that policy is paid. But if the policy were to lapse for some reason, then you're in default on that loan. Where newer farms, smaller farms generally, or growing farms generally come into contact with having to up their insurance requirements are going to be their customer requirements or vendor requirements. And I put two examples. I know Weaver Street Market, that's a local co-op that's here in the Triangle area. You have to have a $1 million general liability policy. If you're making certain products and they're carrying those, that individual relationship is probably going to require you to have something like products liability or something like that. Your marketing outlet requirement. So the farmer's market may have an insurance requirement for you to be able to have a stall there. An example from our local Carborough Farmers Market, the only insurance I could find in their vendor agreement or their bylaws, whichever document I was looking at, was just if you were processing poultry on farm under the exemption that's allowed by NCDA, you have to be carrying this $1 million liability insurance. Again, that is the policy covers an injury that comes from diseases associated with poultry. So the other example I put here under your vendor requirements is Walmart, and if I've just used that sort of an extreme example because small farms generally I don't believe are getting their way into selling those products, but I just took this straight from their a screen capture straight from their vendor agreement, and you see if you're getting into if you're selling to Walmart, you're producing at a large scale. The larger scale you're producing, the greater your risk, even in light of FSMA, even foodborne illnesses. But you see here that you got to have your commercial general liability. That's covering everything that's going on inside of your business, products liability, automotive, and workers' compensation. I'll talk about workers' compensation at the end, but it's interesting that Walmart's requiring that, and I'll get to that at the very end there. I have a student whose farm has a product and they're selling in the Carly Seas chain, which I'm not sure is all the way west to over to Middle Piedmont, but they're pretty prevalent throughout the east and southeast of the state, and they don't require it. That's more of a localized red and white type food store, and they won't require it. So it just depends on what the company wants when you're selling it. So moving further into insurance, generally, again, it's a simple matter of contract between insurer and insured. We do have a state law that regulates what a insurance company that's registered to do business in North Carolina can and cannot put in their insurance contracts, really as a matter of public policy, just egregious out provisions and things like that. But by and large, whether or not the accident or property loss is covered is dictated by the writing in that document that you are signing, the insurance contract. And a breach of that contract releases the insurer from having to, an obligation to insure, but also their duty to defend the lawsuit, which I'll talk about in a second. So failure to pay your premiums, an accident occurring outside of the coverage of the policy, or something outside of the definitions of the policy. And we call those exclusions. And if the insurance agent or the investigator finds out or discovers that this was something that an accident that wasn't covered, then the policy, they're going to deny coverage. And generally it covers an accident or occurrence. Most policies will have a per occurrence amount and then an aggregate amount, meaning that and I guess I'll go back to the Walmart example. You'll see right here, limits of $1 million per occurrence, $2 million aggregate. So that under that particular policy that you have, you can have two $1 million claims. And after that, your policy is not covering the accident. And also generally actually, not just that the insurance policy can cover claims. Here's, to me, the real big benefit is the duty to defend. And what you're also buying when you're paying your insurance premium is the insurance company stepping into your shoes and defending the claim. The insurance company hires a lawyer. They pay for the costs of the attorney fees. They pay filing fees. They pay the costs of mediation, of depositions, of expert witnesses, all of those costs that traditionally drive a general jury trial up into the tens of thousands required in money out of pocket to get to a jury verdict or defend yourself all the way up to the jury. The insurance company pays for that. I got a bit technical, but they make that decision based on, what the general claim happens to be. Now, actually, I'll go through it here in just a second about your duty to inform the insurance company when something happens. But there are about as many types of insurance as insurance companies have come up with. There are insurance companies that cover property only, property damage only. There are insurance policies that cover property and liability, accidents that occur on that property. But the takeaway is that whatever happens to be the title of the policy, whatever the name on the policy is, the devil is in the details, and it covers, again, it covers what it covers. You don't generally find policies that just cover all aspects of farming. Now, there are some out in the marketplace. I'd done some Googling and found some that looked like it covered things all the way up to, custom farming and working for other people and things like that. But generally, you're not needing to be carrying products liability insurance just for selling the product from your farm. Once you start processing, and even when you're processing under safe practices and you're processing under food safety regulations from NCDA, you're still you're doing something there that's increasing your risk. You're taking a raw product and adding things to it, processing it, and the risk for that product goes up. So generally, if you're selling it at the farmer's market, you might not have to have it, but vendors for value-added products of any size are likely going to be requiring that product's liability insurance. I'll talk about workers' compensation in just a bit, and then a policy that you often hear about is the umbrella policy. And generally, umbrella policies are these comprehensive policies that will cover various things up to a certain limit, but they will sometimes be there to cover what we call insurance gaps, coverage gaps, to cover above what another policy might cover. Let's say another policy covers property damage up to $100,000, and that's the limit of that policy. Well, if you have an umbrella policy in addition to that policy, that will cover 100 and above. It probably define a ceiling there, but that's the type of policy you have to again, what we call fill in those insurance gaps. Yeah, I think I keep beating the dead horse here, but I always, as I mentioned earlier, you don't want to go from just what we would call a traditional sale of farm product operation to one that's doing a value added and B, bringing customers onto the farm. The more you're increasing your customer facing activity, and especially increasing your on-farm activity with agritourism, you do not want to start doing those things without first talking to your insurance company and making sure that your coverage is expanded to cover those, because your general farm liability policy, does not necessarily cover your farm commercially. And the policy that covers your farm commercially, again, covers what it covers. It may not cover for injuries that have occurred on the farm. So you don't want you don't want something to happen and then the insurance company is surprised by it, because if they're surprised by it, then they're generally going to, I'm not saying it's a bad thing that they're looking for, but they're going to minimize their own risk and they have their revenues to protect. So if they're not going to cover you, they're not going to do it just as a favor. I pulled an example, and I'm not advocating, for Farm Bureau Mutual Insurance or any other insurance company, but it was just a good list to show you that policies differ. You have your auto, business auto. So your personal auto, that's likely not going to cover you using your automobile for business purposes. What we call what I call the farm owners, that's the basic policy, but it's probably not going to cover your commercial activities. It's just going to cover in case somebody comes onto your farm, somebody, either they're selling something coming up the driveway or somebody's trespassing. Generally, you don't owe a duty to trespassers, but still, somebody getting hurt on your farm nonetheless might try to blame you for that accident. But as you can see, there's a number of different types of policies that become available, and you just have to make sure that you know what covers your business activities. I pulled up this ISOFL basic farm owner policy. This is just a standard form in the industry, and I'll pull that up just to give you an idea, of what we're talking about when we're looking at it. See, it's you have here what the policy actually covers. That's just number one. That's how many 200 words there. And it's generally bodily injury and property damage that occurs on the farm. Then you get number two, and that's exclusions, and you're pretty much from there all the way to the end of the document. In this particular standard policy is specifically excluding business activities. So your farming activities, you're driving your tractor out on the road, liability, livestock escape liability, things like that, generally are not covered by this type of policy. But I'm also not representing the insurance company and averring what is in these policies. So I don't really, I'm not able to, say what exactly it does cover and what it doesn't cover. Just make sure that you know what's in the policy. I think I'm running really short on time. So I'm going to just generally say also that these policies, your commercial policies, they are covering the acts of your employees. If it's your employee that's out on the highway and there's an accident, or they're at the vendor where you're selling and something happens, your policies are generally covering your employees too. This takes us into an area of employment law where you need to be careful to make sure that when you hire people that you're classifying them as employees and paying their FUTA and SUTA and withholding their, doing their tax withholdings, and not just calling them contractors and giving them a 1099 at the end of the year. Generally, contractors carry their own liability insurance. And so your policy is more likely to cover employees, but not likely to cover contractors that you've hired. And that leads me here to workers' compensation. So when I'm talking about injuries that occur to employees, there are policies, the farm policies that I've seen that say that. I haven't read the fine print of the policies, but generally injuries in the course of employment are covered by workers' compensation insurance. And under the Workers' Compensation Act, this is the sole remedy that injured employees have against their employer, or at least to be, for their injuries to be covered when there's a work-related accident. And the weeds on this become what exactly is work-related, what is a side trip when they're off doing something else. Generally, under the Workers' Compensation Act, if you're an employer, you have to, and you have 3+ 3 or more employees, you must carry workers' compensation insurance. If you're an agricultural employer, the number goes up to 10 non-seasonal employees. And so it's become somewhat of a higher bar. Now, I say this, and I've gotten this question over many years, it's like, I want to make sure that I avoid having to carry workers' compensation insurance. And so you might have someone that sets up multiple entities and stays under the limit, and it puts, an employer's ID number for that employee to that entity, and then over here does the same, but they're staying under that limit. I'm like, okay, okay, because in farming is one of the most dangerous, as all of you know, is one of the most dangerous businesses there is, and so I don't discourage employers from paying for workers' compensation insurance. No need to kind of go into the weeds of workers' comp coverage, but generally it's going to cover, for injuries that happen within the scope of employment. Not necessarily insurance, but if you are operating a farm, and particularly if you have farm employees, and particularly if you're farming on land that you own and you have other assets to protect, a very low cost place of insurance is to form an entity, again, which in theory puts your business liability and your business assets in one bucket. And so when an accident occurs, whether you cause it or your employees cause it or whatnot, that any recovery of damages, and let's forget about insurance, but any recovery of damages by liquidating assets is going to stay in that box. Your land, your savings, all your gun collection, everything out there, in theory is kept clear of that particular claim. And the last thing I'll show here is just a general diagram that when you do form your operating LLC, you want to make sure that you get a lease agreement drafted to yourself, executed with yourself, that shows that operating entity is leasing your land and buildings and paying you rent. And that's what I have. And I know a couple of questions popped up in the chat, which I didn't have time to see. I'll stop my share now.
Thank you, Andrew. And those were just some comments and future workshops that came up. But if anyone has questions, for either Rod or Andrew, feel free to unmute yourself. We do have a poll. If you'll answer those last 2 questions for us before you hop off. And we appreciate your time, Andrew and Rod, for sharing with us. And if anybody has questions, please feel free.
I've got